What you see, gold dropping below 2000. You're seeing massive deliveries off of COMEX still over the last couple of weeks. Huge deliveries coming out of COMEX and huge deliveries coming off the LBMA, and gold being priced, almost $100 higher on Shanghai, and silver almost $3 higher on Shanghai. The big money is accumulating and arbitraging and siphoning gold and silver using these ridiculous prices of the West. And yes, 2000 ought to be support, but the reality is it should be a whole hell of a lot higher, and silver should be much, much, much higher.
Although the gold market holds critical support above $2,000 an ounce, it lacks any significant bullish momentum. However, one U.S. bank still sees substantial potential for the precious metal. In a recent interview with CNBC, Aakash Doshi, Citi's North America head of commodities research, said that gold prices could hit $3,000 an ounce within the next 12 to 18 months. President and owner of Miles Franklin Precious Metals, AndySchectman, questions economic indicators at the $2,000 gold price, noting a gap in actual value while citing substantial COMEX and LBMA deliveries. Month Comex Gold for February delivery gained $16 per troy ounce, or 0.80% to $2,027.50 today. Despite ongoing price fluctuations, Schectman observes continuous accumulation of gold and silver. Gold again emerges as a natural destination in this flight to safety. Data from J.P. Morgan Research indicates that global central banks acquired a net 800 tons of gold reserves in the first 3 quarters of 2023. These purchases were led by China's central bank, with the country remaining a steady buyer of gold. Beyond diversifying reserve assets outside of the U.S. dollar, China's accumulation of gold may also indicate its view of global geopolitical uncertainty. Moreover, Schectman urges a focus on macroeconomic factors, including central bank actions, BRICS dynamics, and drained exchanges. For all of last year, the BRICS alliance has made impressive strides in de-dollarization plans. Specifically, Forbes has stated that the BRICS alliance is using gold to facilitate a shift in global demand away from the U.S. dollar. Indeed, they are not relying on the asset as an actual trade currency or the basis for its native currency. Instead, they seek to use different investment vehicles denominated in gold. Now, we present the clips of AndySchectman's insights from his recent interview with Arcadia Economics. Before we continue to delve into this discussion, please subscribe to our channel and activate the bell icon for timely updates.
2000 is certainly a round number and appears to be support. It was resistance for a very, very long time. The fact that it came right back up is certainly bullish, and always coincides with some sort of numbers that are being released, whether it be the inflation or the unemployment numbers. And look, inflation is coming in much hotter than they anticipated, and well, that's not much of a surprise as far as I'm concerned. But the numbers that we keep being told, whether it be employment numbers and the price goes down, or the inflation numbers, they just seem to be less than accurate, I guess you could say. And the market reacts, or given a little bit of a push to react to those markets, certainly to make the system in an election year seem stronger than it is. They bring out all these big employment numbers in January. They will be revised, just like the entire 2023 numbers were revised downward by 40%. The revision in the unemployment numbers and the lack of clarity and transparency, and the changing of the metrics used for gauging inflation in the CPI is justification, when these numbers come out, for short-term gyrations in the price of gold, and it's just more of the same. The noise, as far as I'm concerned, it's all noise. And the short-term movements, the short-term gyrations, the short-term technicals, to me, don't have much bearing whatsoever on the ultimate direction of the market moving forward. And again, look, I don't care what you see, gold dropping below 2000. You're seeing massive deliveries off of COMEX still over the last couple of weeks. Huge deliveries coming out of COMEX and huge deliveries coming off the LBMA, and gold being priced, almost $100 higher on Shanghai, and silver almost $3 higher on Shanghai. The big money is accumulating and arbitraging and siphoning gold and silver using these ridiculous prices of the West. And yes, 2000 ought to be support, but the reality is it should be a whole hell of a lot higher, and silver should be much, much, much higher. One of these days, you will see a positioning like we see right now, where the commercial banks are in a very bullish position and the manage money in a very, very, in a short position and in a compromised position should the price start to go higher. And the question is, at what point will the commercial banks not sell into a rising market? That's really the question here. And Ted Butler talks about this all the time. Maybe we'll see that happen this time. Maybe this will be the move up. Maybe it won't be. But through all of this noise, we see the most well-funded and well-informed traders on the globe continue to drain the exchanges, continue to accumulate, using this price, this volatility in this tight trading range that people make a big deal of. But look at it from a step back. It's been in a trading range forever with great volatility. That's enabled the big money to pickpocket the exchanges. If it goes too low, it gets too much attention. If it goes too high, it gets too much attention. But keep it in a tight trading range with great counterintuitive and volatile price action, and you can systematically drain the exchanges. So I think the mistake a lot of people make is looking at the micro and looking at the short term and look at the big picture and see that the economic picture, see the big picture with the BRICS, see the big picture with the central banks accumulating it, see the big picture with the exchanges being bled dry.
AndySchectman emphasizes the consistent appreciation of gold's value since 2000, outperforming the S&P and the bond market. Gold has long been considered a durable store of value and a hedge against inflation. Over the long run, however, both stocks and bonds have outperformed the price increase in gold on average. Nevertheless, over certain shorter time spans, gold may come out ahead. Andy observes countries like Russia, Iran, Saudi Arabia, and China are moving from the dollar and investing in gold, challenging the dollar's reserve status. The US dollar now accounts for 58% of foreign exchange reserves held by overseas central banks, a record low. Gold, the most ancient widely accepted international currency, has chipped away at some of the dollar's dominance, accounting for 15% of reserves, up from 11% 6 years ago. For decades now, there has been a great deal of speculation about a potential plunge in the value of the dollar. 2024 will likely not be the year when the dollar's reserve currency status outright ends. That said, it pays to be prudent. Let's get back to the interview.
I agree with Luke that you don't need to see a common settlement currency or a common reserve currency because, look, if you look at the price at the value of gold since 2000, it's appreciated by 7.8% per year. The S&P 7%, the bond market a fraction of that. So when you look at these countries, they say, look, what the hell do we need to take the dollar and buy treasuries for? That was the petro deal. You value oil in dollars and take the excess and put it into treasuries. But why hold treasuries when last year, for the first time in 45 years, they were way more volatile than the gold price? But go back to 2000. Gold is appreciated by almost 8% per year. And it doesn't have counterparty risk. And it doesn't have the risks associated right now with this system, interest rate and inflation risk, the way that the bond market does, or the default risk. And it has no counterparty risk if it's in your own possession. So what all of these countries have been doing, which is putting great strain on the settlement value of the dollar, which ultimately hurts the reserve status, is they're trading with one another in local currencies. Egypt just came out and said, all the BRICS countries need to do this. We're already seeing it in Russia and Iran and Saudi Arabia and China. They're all trading with one another. India using local currencies. And instead of putting their excess currency into US treasuries as they've done, they're selling them and putting it into gold. So the lack of settlement in US dollar currency starts to disrupt the reserve status of the dollar ultimately. And when you then pull the reserve influx out of the equation and put it into gold, as that chart is showing, well, that's these countries making a decision that, look, we don't need to settle in dollars and we don't need to save in dollars and in treasuries. And that is why you don't need to have a BRICS currency per se, just an agreement amongst these countries where now 35 more countries have joined, 20 have expressed interest on top of the 10. You put that together with the Belt Road and the Eurasian Economic Union and the Shanghai Cooperation Organization, you're talking almost 9 out of 10 people on the planet. If all of these countries say, you know what, screw the dollar, we agree to trade with one another using our local currencies. And, I got that first ever trade last week using Project Enbridge, which is the bridge between central bank digital currencies. And in this case, it was United Arab Emirates trading with China using the M bridge, which sidesteps SWIFT. So now they have a way to trade outside the SWIFT system using their own local currencies, accepting their own local currencies, and then putting the excess into gold. And in the case of China, you have all of these countries like Iran who've been doing this for a very long time, sidestepping US sanctions by trading with China, selling them their oil, getting yuan in return, and exchanging it immediately into gold on the Shanghai Gold Exchange for delivery. So, again, the recency and the normalcy bias of the dollar bulls will be to their unwinding. And a guy like Luke, who is so smart, and he's really, I put him at the top of the list in this industry of economists intellectually, but he's spot on there. You don't need a common currency to massively distort and disrupt the reserve and settlement. Well, let's call it the settlement and ultimately the reserve status of the US dollar. It's happening in real time. And that's what that chart shows you.
The outlook for gold remains intriguing, with many factors influencing its trajectory. Gold and silver have been enduring symbols of wealth and power for thousands of years. Today, precious metals are also a separate asset class from stocks and bonds that offer a safe haven for investors amidst uncertainty. How do you envision the future role of gold in the global economy in the face of increasing investment by countries in this precious metal? Share your thoughts in the comment section below. If you find this video informative, don't forget to support our channel and turn on notifications to stay informed about our latest videos. See you in the next video.